Recording in progress.
Hello everyone, nice to meet you, and this is me Wahyudi Akbar Sugeha with my IPM 214111090. I'm from Technocrat Indonesia University, specifically from Faculty of Economic and Business. Right now, I will explain about capital budgeting, and this is the one of topic that I have to learn in financial management. So I have to share it, and then I have to learn together with you guys. Okay, what is capital budgeting? Capital budgeting is a key aspect of corporate financial management. Its purpose is to ensure that the company has sufficient funds to support the long-term investment required for business growth and development. The capital budgeting process involves assessing potential investment projects, selected the most profitable project, raising the necessary fund, and managing those assets over their lifetime. Capital budgeting can also help a company to identify optimal sources of funding, such as loans, equity, or shares, as well as quantify the level of risk associated with the investment. Good decision in capital budgeting can have a significant impact on the financial health and long-term growth of the economy. Let's move. What is the benefit of capital budgeting? Capital budgeting has important benefits in various aspects of business management. Some of its key benefits include the one, growing the detailed fund requirements. It means capital budgeting helps companies to plan for every detailed funding needs. By detailing how much capital is required for investment in physical assets, product development, or business expansion, the company can identify the source of funds required. This helps the company plan appropriate source of funds, including an internal financing, debt, or equity capital. The second one, we have preventing overinvestment. Capital budgeting helps companies prevent overinvestment, which occurs when a company spends too much on a project or asset that doesn't provide an adequate return on investment. By planning carefully, the company can avoid wasting valuable resources. The third one, we optimizing the use of resources. By budgeting capital appropriately, companies can allocate their resources more efficiently. This means identifying the most profitable project or asset and focusing on them while reducing or delaying investment in less profitable things. The next one, we have improves managerial decision. Capital budgeting help in making better managerial decision by having a clear picture of the requirement investment, their impact on cash flow, and the potential return on investment. Managers can make more informed and intelligent decisions. And the next one is identifying potential source of problem. The capital budgeting process can also help companies identify potential problems or risks that may arise during project implementation. This allows the company to plan the necessary mitigating actions. The next one, improve accountability. By having a detailed capital budget, companies can measure actual performance against the budget. This increases the level of accountability within the organization with and allow managers to evaluate whether project or investment are on track. And the last one, we have facilities, internal and external communication. A capital budget can also serve an important communication tool both within and outside the company. It helps stakeholders such as lenders, and investors understand the company's plans and confidence in the management of funds. Thus, capital budgeting is a critical management tool in planning, managing, and optimizing the use of the firm finance resource. By implementing capital budgeting well, companies can avoid mistakes in decision making, avoid overinvestment, and achieve their financial goals effectively. And the next one, we have steps capital. This is step by steps capital. Capital budgeting is a process of planning and managing the financial resources required for investment in physical assets or long-term projects. The stages of capital budgeting include of a series steps that need to be followed to ensure that capital allocated is done wisely and efficiently. The following are stages of capital budgeting. The first one, we have to identification of investment opportunity. The second one, we have to risk assessment. The third one, we have to cost and revenue estimation. The fourth one, we have to return on investment calculation, and then project selection, funding research, budgeting, implementation and monitoring, and then the last one is post-project evaluation. Thus above states help companies or organizations to take the right decision related or to their capital allocation in order to achieve long-term financial goals and increase company value. And the next one is criteria of investment revenue. Budgeting assessment criteria for investment revenue may vary depending on the company objective and policies. Some common criteria used in assessing investment receipts include: first one, payback period. In payback period, we have criterion. The investment is considered acceptable in the payback period, the period of the time required to return the initial capital, in less than the period set by the company. Interpretation: the shorter the payback period, the faster the initial investment capital can be returned. We have the second one, accounting rate and return, ARR criterion. The investment is accepted if the ARR meets or exceeds the rate of return set by company. And then interpretation: the higher the ARR, the best the investment, but this can be less accurate measurement as it doesn't consider the time factor. And then the next one, we have net present value and PV, net present value criterion. The investment is accepted if the NPV is positive. In this case, NPV is difference between the present value and the cash inflows, and the present value value of the cash outflows. Interpretation: a positive NPV indicates that the investment is expected to make a profit assuming an appropriate discount rate. The next one is internal rate of return, ARR, internal rate of return. Criteria is the investment is accepted if the ARR rate is higher than the discount rate set by company or higher than the expected rate of return. Interpretation: a higher ARR rate indicates a higher and better rate of return. Profitability index, PI, profitability index. Criteria: the investment is accepted if the PI are greater than 1. PI, the ratio of the present value of cash involved to the present value of cash outflows. Interpretation: a PI above 1 indicates a profitable investment, while a PA below 1 indicates a less profitable investment. It is important to note that each company or project may have different investment acceptance policies and criteria. The selection of these criteria depends on the company objective, risk, and investment strategy. In addition, policies may change over time according to changes in the business environment and company objective. Let's move on. We go to methods and address risk in capital budgeting. In capital budgeting, risk is an important factor to consider. Two methods often used to address risk in capital budgeting are the generally equivalent method and the risk adjusted discount rate method. The first one, certainly equivalent method. The certainly equivalent CE method is an approach used to address risk by assuming that all projects have the same level of risk. This allows the comparison of projects with different risks within consistent framework. In the CE method, usually the discount rate used in the discount rate that describes the company's cost of capital without considering risk. With this method, all project cash flows are discounted at the same rate. This allows for a fair comparison between different projects. The second one, we have risk adjusting discount rate method. The risk adjusting discount rate (RADR) method is a more complex approach that considers risk in the determination of the discount rate for each project. Under the RADR method, the discount rate for each project is customized based on the risk associated with the project. Projects with higher risk will have higher discount rate, while projects with lower risk will have lower discount rates. This reflects that projects with different level of risk will be valued in line with their respective risks. The RADR method is more complex than the CE method, as it involves a more detailed assessment of the project risk, and the discount rate will vary according to the risk level of each project. However, it provides a more accurate picture of the value in the situation where project risks vary. Both of these methods can be used in capital budgeting, but the choice between the too will depend on the extent of which the company wants to consider risk in the determination of project value. If the company wants to assume 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 that all projects have the same level of risk, the ZE method could be more appropriate. However, if the company wants to accommodate variation in project risk level, the ADR method could be more relevant. That's all from me. And then, if you have any critic and then any question, you can leave in the column commenter, and see you next time in the another video. Thank you.
Recording stopped.